Good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil trading up a little bit this morning at a little over $71 on Brent. It would appear we've had some obviously geopolitical tensions return over the weekend with severe bombing of Yemen by the U.S. forces. Just sort of warning them to stay away from their activities in the Red Sea. We've also had some somewhat positive demand news out of the China. China economy has a heartbeat. Let's kick off this Monday morning, as always, with Omar Najia, Global Head of Derivatives at BB Energy. Omar, your thoughts at this somewhat recovery in the oil price since we talked a week ago? Are the factors that are propping it up sustainable?
Well, um, look, let me put it this way. I think basically that we've had such a big move to the downside. I don't think anything is sustaining this kind of or behind this kind of bounce, except for um, some kind of relief kind of rally. So unfortunately, no, I'm still negative oil. Uh, The stock market, I think, seems to have found a bottom. If not, we're very close to one. And I don't think the bombing of Yemen or the Yemen's retaliation against ships that's to come. I don't think that changes anything really in terms of a premium to the price of oil. And I think the bigger picture is still the unknowns in the market. Hence, everything is basically coming off except gold, which is a flight to safety. And you've even seen the dollar, which is usually a safe haven, getting sold off massively, right? So I think we continue to see dollar weakness. Oil, I think, is I can't see it really rallying strongly. I think rallies will be sales. WTI, we're looking at a number of 63.70. And I think if we break that, that'll be basically the death knell for oil. And then maybe we can start to see it trade with a five handle, 50 something for WTI. But I don't see anybody who's kind of in oil's corner and wanting prices higher. Not OPEC, not Saudi, not Russia, not anybody. So I think the geopolitical forces want to push input costs into the global economy, i.e., oil, lower. And I don't think there's very much that's going to stop that.
Let's welcome Matthew Wright, Senior Freight Analyst at Kepler. Matthew, I mean, while we've all been distracted by the sort of Trumpian Revolution 2.0 and all of its tsunami of headlines, we've kind of taken our eye a little bit off the ball of the Red Sea. And since the ceasefire in Gaza in January, it sort of has diffused at least the immediate red hot tension in the neighborhood, and things seem to have calmed down in the Red Sea. Maybe bring us up to speed on is that the wrong perception? What are the Americans reacting to? Did we miss something while we were watching all the drama in Washington?
Yeah, a little bit, but generally speaking, that's accurate. So, the Houthis announced that following the Gaza ceasefire, that they would no longer be attacking any vessels that did not have Israeli links. So that was sort of already percolating. So there was sort of a ceasefire in the Red Sea. Unfortunately, for a lot of ship owners, this wasn't enough. And we haven't really seen any increase in tanker transits in particular, but in any transits whatsoever. And that was really because they were sort of taking the Houthis at their word that this was going to be a ceasefire that was going to hold and that they could transit safely. Now, as it happened earlier last week, the Houthis came back and said, we're now gonna start attacking Israeli ships again. Although they never really said that they weren't, so there was a bit of a mismatch there in terms of their language. And I think part of Trump's agenda, is to sort of, we've got the strong impact they're going to have on Iran, Iranian exports. I think he's trying to bring back a bit of normalcy to the US dominance and openness of global seaways. And I think, to an extent, this was a bit of a failure of the Biden presidency that he had allowed this incredibly important global choke point to effectively be choked off and nothing. Now, I can't comment on the effectiveness of Trump's plan, because the Biden administration and the US military did target a lot of ports in Yemen. So it's yet to be seen if this does anything. As Omar highlighted, we will see a retaliation, undoubtedly. The Houthis did a very good job of disguising their locations, spreading out the locations so that they could continue to attack ships, even while the US military, and they had that coalition navy for a little while passing through the Red Sea. So it's yet to be seen what, if anything, this changes. That you can be pretty certain a weekend of strikes won't be enough. And I think the US themselves have said this is probably going to be a number of weeks before we see any change. So I think we'll have to wait and see, what happens there. But, guaranteed we're definitely not going to see any change in vessels passing through the Suez Canal or the Bab el-Mandeb Strait.
Let's welcome Gaurav Sharma, journalist and energy analyst, back to the table. Gaurav, I wanted to sort of get your sort of overview of the Trump 2.0 revolution and what part of it could have the biggest impact on oil prices moving forward. We've seen, obviously, in recent weeks, all the noise and policies of the global trade war, the tariffs on everybody, the reaction to the tariffs. We've had the crack in the Western alliance and the apparent shift from US to Russia. But also over the weekend, I think a notable development as well to add to the Trump 2.0 revolution, and that is the erosion of the US judiciary, which is, of course, a critical third branch of the US government, the judicial branch, and the disregard of their decision blocking the extradition of Venezuelan nationals to a prison in El Salvador. Your thoughts on the sort of overarching 2.0 revolution of Trump and where you see the biggest impact going forward on the oil markets?
Sure. You see, if you look at Trump, he tries to create this perception that we will do what we want. They create this kind of, and that explains your Trump 2.0 psychology. And here you have this man on record saying he wants lower oil prices because they're price positive for the American consumers' pockets, and so on and so forth. And that creates a perception. It also ties into a string of CEOs last week at CERAWeek who came on and said, started discussing. This is always a good point. It harks back to what Omar was saying. They started discussing at what point, what price would shale be competitive? $45, $50, $40, take your pick. Everybody had one. And they also started mentioning that they see that were that to happen, US production would peak between 2027 and 2030. Now, when this enters discourse, instead of table thumping and saying, there's an OPEC put in place and so on and so forth, you do tend to wonder, oil prices are heading lower. Is there anything supportive of oil prices, as Omar was saying? And Trump factors into that. Here's this man who comes in, he says, I'll rip that up, I'll tariff this person, I'll tariff this country, what are trade norms, what's the judiciary? You create this perception that it is quite bearish. And as you see, that a whole host of asset classes suffer, but yes, there's a flight to gold.
Omar, looking at that, obviously the flight to gold, which is clearly one of the defining outcomes that didn't just start with Trump. We've been sort of a good year and a half into this gold surge, doubled in price in the last 18 months, I think, 2 years. But there's also the dollar weakness. And now we have this week the central banks coming back into focus. The Fed meeting midweek, expected to leave rates unchanged. But these other factors, these other references, the dollar, the gold, the Fed rates, are impacting, not impacting going forward, do you think, on the oil markets?
No, I think basically not impacting on the oil markets. The USD has been weak for a while, right? The idea, I mean, I don't know if you've seen, but the interest expense of the US government now for its debt is 1.2 trillion. It's going off the charts. It's nearly parabolic, right? They have a massive problem. The likelihood that they won't cut interest rates is zero. The only question is how long they wait before they do. But they're going to cut, and they're going to cut big, not because of anything, because they need to, because they can't afford to keep, So basically, what Trump is doing, he's presiding over a kind of, the decline of the US, but doing a lot of arm waving, and
I
we're
mean, he
going to
seems
make
to
it
be
all
somewhat
great again.
accelerating it. I mean, in a sense, he's sort of, the
He's
inevitable
selling it.
outcome is lower interest rates. I mean, if you drive the thing off a cliff, interest rates
Yeah.
have to come down, right?
Yeah, he's selling it. So he needs to do impossible things. He needs to keep the oil price down, the stock market up. He needs to cut interest rates at the same time, and he's got to weaken the dollar, right? So he can do three of those four without a problem. So weaken the dollar, push the S&P higher, and push oil lower. But the interest rates, that's the key. And without having a quote, you can't make it so obvious that basically everything is roofing, and you come and you say, we're gonna cut interest rates now to make it roof even more. So he needs some kind of excuse to come in and push Jay Powell, or the Fed, because they're not under directly his control, to come and start doing this cutting, et cetera, et cetera. The idea with gold is, you've got physical oil moving, a lot of it now moving to the US. And per chance, you also happen to have basically Musk and Trump saying, maybe it's a good idea to do an audit of Fort Knox, because maybe all the gold isn't there. So I don't think they do that if they don't know that the gold is there. But I think maybe some of it went walkabout, so they're just making sure that it's all there, and then they'll come and say, well, it wasn't all there, but we managed to fix it, and all this kind of stuff, blah blah blah. So I think that's the story with oil. But I think the US has a lot of basically big problems to do with their economy, to do with how much money they're spending. Hence, you get this sideshow called Doge. We're going to save 10 billion here and 5 billion there. Meanwhile, they're on they've spent 40% more or projected to spend 40% more in the first 3 months of this year than they did last year, which had a true $1 trillion deficit. So
it's on any macro level a bit of it's a train crash on any other day of the week, other than this new world we're in, where printing money seems to be the new normal. Matt, looking at the idea of China recovery, which seems to be in the headlines over the weekend, China showing some heartbeat, if you like, just sort of against the dominant narrative of the first quarter of the year so far. It's all been sort of China bearish, China weakness, but there's some positive numbers out over the weekend regarding consumption, etc. Do we see anything in shipping and tanker rates and flows into China that tells us that backs up that narrative? China to outperform the expectation?
Not yet. So this is certainly, from a tanker owner's perspective, this is certainly encouraging news, because it's been almost more than the first few months of this year, because the tanker market had a big correction downward over the second half of last year, and it has never really come out of it yet. Even with the situation in the Red Sea and the Russia-Ukraine war, which have added sort of a sort of new baseline. The market has sort of still been a bit sluggish. Even the sanctions we had on January 10th, they've sort of added sort of small impetuses, but it hasn't been enough to really lift the market much. So this will be good, and a lot of there is enough data just on the oil side to indicate that we should start to see a bit of an increase in Chinese buying over the next couple of months, even amid spring maintenance. And that's just because they drew down very heavily on onshore inventories over the past 3 or 4 months. And that hasn't, and we've seen also a pretty steady, almost increase in refinery runs. So imports have stayed low. So there is this gap that needs to be replenished just on the crude side alone. So this, that is certainly going to continue to support the narrative that China could actually increase imports over the coming months, potentially.
Gaurav, looking at some of the issues we just talked about earlier, these tug of war between supply and demand sort of pulls. We've obviously just spoken there, Matt, signaling what the demand outlook from the China might be, the world's largest oil importer. We've had earlier comments about the supply risk associated with the US bombing of the Yemen, and that the bombastic language, of course, was par for the course with this US administration. Their language is always more dramatic than most, but ultimately they're real bombs dropping on real people, causing havoc there, and that's to continue. So we've got our supply threat thing there. And now the other element we have coming this week and being very significantly flagged by the US government is a telephone call, a second telephone call, maybe more, but certainly a big telephone call between Putin and Trump on the negotiations regarding a Ukraine ceasefire. Your thoughts on that whole theater of Ukraine, the direction it's going, bullish or bearish, and your expectations for the phone call?
Look, bearish. I'll set that out from the outset, and I think the reason for that is that Trump wants this settled ASAP, no matter how messy it is. He's saying, well, the Americans, we shouldn't really be backing you or doing this, and we can negotiate with Putin and everything else. It will not be any kind of a perfect solution anyways, if there is such a thing after all. But Trump wants it ended ASAP. It will be messy, but it will be settled. And a lot of people in the market are factoring this into their thinking, that this conflict will come to some kind of an abrupt end, courtesy Trump. It won't be perfect. It'll be completely messy, but it will end. And that is factoring into the wider scenario. There is not really much of a geopolitical risk going on there. So ditto applies to sort of other places where Trump has been involved in. And then we come to the issue of Iran, the language, as you just mentioned. It has to be bluster. There has to be Trumpian aplomb in there. But last time he was in the White House, he was quite effective in neutering Iran. It remains to be seen what he does this time around.
Let's go to the survey question, which tackles some of the themes we've been discussing, which is what part of the Trump 2.0 revolution could have the biggest impact on oil prices moving forward? The global trade war, which has been a big feature of the last month, and we're expecting April 2nd that there'll be a global universal sanction or tariff everybody on some reciprocal model that will tariff you equal to what you tariff us, and so forth. The erosion of the judiciary rule of law in the United States, we're seeing the courts making decisions and the new administration essentially ignoring them. The breakup of the Western Alliance, or the cracks in the Western Alliance, which has clearly been a big feature of the last month, or none of the above. What part of the Trump 2.0 revolution could have the biggest impact on oil prices moving forward? Omar, just on that point, the commodity markets, the financial markets, the US is the biggest and deepest liquidity of all of those markets. It sits on a fairly fundamental anchor of that there is a judicial framework to these financial markets. There is accountability, there's recourse. If we start to see an erosion in that pillar, is that something, do you think, that could emerge as a concern? Obviously, the tariffs have emerged as a concern, other things. Does the disregard of judicial decision-making in the US provide any concern for the financial markets going forward, do you think?
Yeah, I think, I mean, what the US needs to do is get this debt under control. And I really honestly don't think it will, because it's too far gone. So Trump's going to throw everything at it. He's going to throw crypto at it. He's going to throw tariffs at it. He's going to throw taking new countries and annexing them and whatever. And he's going to try everything there is to try. But if you look at it, I mean, some people think that it's a kind of, he's a genius savant kind of thing. Other people think that he's, much more towards the kind of, idiot kind of spectrum. But I can't see. I mean, all I see is flailing about from one thing to another, which basically makes me think that it's kind of a panicky kind of thing. So,
When you
and if
talk a lot about the debt, sorry to interrupt you, Omar, but you talk a lot about the debt issue. Do we have to start to factor in, do you think, the possibility in the Trump sort of universe that not meeting the US debt obligations? I mean, at the end of the day, the dollar is only worth what the promise is to pay, right? It's a promise to pay this amount of money. Are we entering into territory where that has to be considered, do you think, Omar?
No, I think basically the US can pay its debt simply by printing it, right? So it's not the issue. The issue means that basically the dollar will continue to be debased over time. They print their debt and they give it to you, but the US has a problem, because the US is issuing all its debt at the front end of the curve, which means that right now, in the next 6 months, they have about 8 trillion, call it, dollars that they need to refinance. That's just to refinance plus new debt. Now, why is it all at the front end of the curve? Because they can't sell 5-year bonds and 10-year bonds and 30-year bonds. Why? Because there's no appetite for it. Why? Because people believe that if you give them money over 30 years, it's not that they're afraid they don't get their money back. It's that they're afraid that in 30 years, instead of a burger costing $5, it's going to cost 50. So it's pointless. So everybody will give them money. They're not afraid of getting it back. They're just afraid of that debasement on the long end of the curve. So all the debt, a lot of it is basically at the front, and any new issuance is all going to be at the front end of the curve, which is why in the next 6 months they need to drop those interest rates. Otherwise, they're cooked. It's not just they need to refinance $8-9 trillion. They need to refinance this plus issue another, whatever it is, $1-2 trillion, right? So that's the problem. It's not a question of am I going to get my dollars back? It's a question of what's that dollar
When I
that
get them back, will they be worth anything?
Yeah. Yeah.
Matt, the big sort of story of the beginning of the year, which sort of contributed to that moving Brent above $80 in January, was the clampdown on the dark fleet, the sort of last minute Biden sanctions that came in early January. What has been the impact on that? Generally, you're hearing reports that with the oil price on these lower levels of 70 and WTI lower, that it puts Urals into the money, so to speak, and so the oil price cap this is under control. Where are we at with those sanctioned vessels, the dark fleet? Is it shrinking? Where is it at this point in time, and where is it going, do you think?
Yeah. So this was the 183 vessels, and there was about 143 that are tankers that are of interest, is the way I describe it. And their utilization has really dropped off. That some of them are still doing some deliveries. We have the occasional one delivering into China, so showing that there is some vessels ignoring the OFAC sanctions, but broadly speaking, their utilization has dropped down. And what this has meant is freight rates from Russian East and Russian West have rose very, very sharply and have sort of remained there. As a nuance, it's a bit of a nuanced story, but what we've actually seen is the impact in the exports of ESPO and the East have been more affected, because more of the vessels that were sanctioned were operating in the East. And this was because ESPO is a higher value crude. The Treasury had more evidence that these cargoes were being traded above the price cap compared with Urals and some of the more Western grades. So what we've actually seen is a lot of vessels flooding in to try and service ESPO. And so we're seeing a net shift of vessels, of Aframaxes that had been trading Urals or Russian fuel oil, moving across to try and keep ESPO moving. And that's, Urals is moving fine, that's no problem. But the freight rates there are now creeping higher and higher just to make sure that there's enough supply. So at the moment, it's not a case of new vessels are actually being pulled in. What we're seeing is vessels that weren't included in that sanctions package are now working a lot harder to just do Russian trade, because a lot of them that weren't sanctioned would also do other credit. They do some Libyan, some Iraqi, some Med. Some of them would do US from time.
So they could be dark fleet one day on Monday and sort of be in the money clean on Wednesday.
Yes. Well, this is the shadow fleet. This is a little different to the dark fleet. These are the dark are the ones that are just doing sanctioned trade from Iran and Venezuela. The shadow fleet are, it's a bit of a question mark about them, because, they were sold since the invasion in 2022 with the sort of notional purpose that they were going to just go and, service Russian trade. But some of them just dipped their toe. Some of them have gone all in.
Gaurav, last word to you. I wanted to get your thoughts. Always good to have your insights on OPEC plus decision making. Of course, we are now 2 weeks away from the beginning of the sort of a fairly significant shift in OPEC plus policy, from a number of years of very severe cuts to now one where we're going into an increasing cycle of production supply, capacity supply increases. Your thoughts on that decision? Is it demand driven? Is it sustainable? Does it continue into May, June, and so forth? Your thoughts?
My humble opinion here is that OPEC has always been late to the party. It was late cutting and it's late releasing its barrels. This should have happened a long time ago. Now they're caught in the cycle that they had to be reactive rather than proactive, and they finally ended up doing what they did, which is said we'll in small increments we'll go back to our levels. The 8 producers who did. I think this is going to continue. We have the OPEC seminar in July, where they'll welcome the world to their corridors. And I think you will keep having this tussle about whether we should keep doing it in phases or we should be more aggressive. Now, back in the day of Al Naimi, they were really aggressive in terms of releasing barrels. I don't think we're quite going back to that when it comes to the Saudis. And what the Saudis do, the others kind of have to fall in line.
Well, we're going to have to leave it there with Brent Crude trading a little bit up here. On this room thinks that global trade war is the biggest deal for the oil markets. Keep your eye on the erosion of the judiciary, I say, because I think that's a big one. Of course, this is the most important day of the year. It's St. Patrick's Day. And what does Bloomberg do but put out a story of Ireland being the target of Trump's tariff wars? And I kind of slightly giggle on the few things, but nonetheless, it's quite serious because it employs a lot of people in Ireland. But the 3 biggest things that are in the trade deficit is Botox that's made in Ireland, that lovely drug that helps men be nice and fertile till late in their age. And of course, the new fancy drugs, the weight loss drugs that are all the rage these days, also made in Ireland. So these 3 things, Mounjaro, Botox, and the other one are all the rage, and apparently they're going to have to move back to the United States. So Ireland might lose those. That's the Paddy Day story. Matt, great to see you. Great to have you back. Omar, as always, Monday morning isn't the same. I wouldn't know what to do with myself if you weren't there. Gaurav Sharma, thank you, mate. Great to see you. Look forward to seeing everybody soon again. All the best.
Cheers, bye.
Thank you. Bye-bye.
Thank you.